Joining us now, is Deepak Shenoy, who's the founder and CEO at Capital Mind, to give us his perspective. Deepak, welcome. This is Harsh. Uh, Quickly, while we were on some of these gas counters, do you have a view on any of them and how this is expected to play out? I'm pretty sure you heard Somit give his perspective.
No view on the gas counters. We don't have a position any in on the gas thing in the PMS. But there has been, I think, a lot of movement in the market in general. So some of our algorithmic strategies may still pick up on them. Fundamentally, we don't have any positions.
A point taken. And what about Reliance, Deepak? Would that at all interest you? Some petrochem headwinds coming in for China. Would that likely benefit something like a Reliance? I know maybe specific stocks is tough, but just give us your perspective with regard to the headwind and the possible opportunity, if at all you have one.
Yeah, so I think we have a very interesting position in the world in terms of in general. We are going to likely import a lot more oil from America, possibly other than Russia as well. And we are in. I mean, that just changes the profile of the returns that a company like Reliance or any other refinery has, because what shale oil is, which is what the US is exporting, is very much more light sweet than the heavier grades of fuel that many of the other refiners are used to. So you have to change your refinery configurations when you change into more American oil versus more Iranian oil or anything like that. So it is some kind of a configuration change. But primarily the margins will go up only if GRMs go up for Reliance. This is a smaller and smaller version of the business for Reliance in general. I feel that longer term we're going to see their geo and retail businesses be a much bigger part of their profitability. So while this is reasonably big now, I don't expect this to last much longer in terms of size. So the long-term view is that the other parts of the businesses are more attractive.
Okay. All right. And Deepak, just asking you something more broad-based. What do you make of everything that's happening globally at this point? Give us some perspective on what your views are. What are you doing at this point? And what are you advising and what are you hearing on ground?
So yeah, I mean, we've had, I think, a lot of drama that's happening in the international circles. I think nobody knows where we're actually going to be, because if I asked you on any given day, what do you think tariffs are, your answer will be different, and perhaps on Monday or Tuesday, your answer will be different again. So, given this kind of a situation, my overall view is that uh, the world is going to get isolationist in that way, in the sense trade is going to be a smaller part of growth going forward, and it will be a lot more in terms of manufacturing, owning supply chains as countries, and in individually within the countries itself, there will be a lot more focus on building for the domestic economy, especially in countries like India. In countries like China, it's already happened. They focus a lot on their domestic supply chain. In India, it's new, and we are going to be forced to it. America is trying to do it anyway. They will take another 5 or 6 years. Europe hasn't. Europe has actually done fairly well at getting their supply chains going, and although they have large amounts of dependence on both China and Russia, they've been able to kind of healthily get away from it. So, in that sense, your next big moves are not going to be from the global exporters or something like that. It's going to be from perhaps more and more companies that serve domestic markets. And in India, the domestic market is fairly large. Our middle class population is probably 2x the size of France or 3x. And that itself is a large European country on its own, and that's the middle class that's growing on a yearly basis. So the next decade belongs to people who will be able to serve this middle class from an Indian investor's perspective. There will also be worldwide opportunities, but India has relatively less opportunities to take advantage of them, primarily because of trade barriers and all sorts of things that will come in. But we should, look at it from a perspective that there's a little bit of a reset in the world's trade orders. And that reset will probably benefit us if we take advantage of it by building more for having policies from the government level, also from investors level, investing into companies that will probably, make more for the domestic market, whether it's consumption, whether it's domestic manufacturing, defense, railways, and so on. So the themes here have, on a macro basis, changed. But I expect this next year to be a lot of pain. Yeah, you will see some gains also, like days like today, which are very nice. But you will also see lots of painful days, basically because this reset requires time, and markets don't like this uncertainty. So there will be a lot of pain. And we've seen how even a little bit of pain, the US had to backtrack on its tariff announcements because the US bond market went into a little bit of turmoil. So markets do determine policy action also going forward. So you're going to see a lot of uncertainty both in markets and in policy action. So you have to brace for impact, but I'm longer term very positive about India.
Mr. Shenoy, good afternoon. It's Puneet this side. Just wanted to take a point forward that seeing a lot of uncertainty globally as well as because of the tariff moves. Do you think that IT as a space is somewhere where investors can hide? And what do you make of the TCS results yesterday? We did see that revenue largely is in line, but slight miss on EBITDA. But the company did call out some tactical intervention and promotion that they did. Do you see the TCS results largely positive, largely in line? What's your view?
Well, the results are hardly good. We own it, so it's just terrible results in that sense. So while we may say they met estimates and all that, that doesn't mean anything. It's just not grown meaningfully at all. So we should not highlight these results. But the bigger problem in TCS is very simple. Your biggest customer is the US. The US is going through a massive change. Most likely, that customer is going to see recession because the way they're cutting, US is cutting jobs, government jobs, cutting out government spending, reducing imports or making imports very expensive, adding inflation. These are all, standard reasons. Each of them can be a reason for a recession, but you put all of them together, you'll definitely have some kind of clamp down in consumer spending, in general, job availability, security, and so on. So in general, I would say that the overall business of a TCS is not threatened because of tariffs. There are no tariffs on it, but it's because their customers are going to struggle through this uncertainty. None of them are going to want to give them big orders right now because they'll be like, I don't know what's going to happen tomorrow. Wait till this happens and then we'll talk. So till that time, you would expect that TCS will have a rough, and all of the IT companies will have a rough time, especially if they're focused on the West, which most of them are. There are a few companies that are focused on certain sectors also, like auto, where there's also going to be damage because auto worldwide, because mostly want to export cars into the US and all that. And the US has put tariffs at least 10% right now, probably more later. There's going to be some kind of a counter impact on them. But I think all of this is going to happen over the next 6 to 8 months. Once the situation resolves itself, I think these companies have very strong balance sheets. They can use the time to purchase or buy their competitors worldwide who may be able to add value in the longer term. They may be able to also expand their services into areas which are currently nascent, like AI, perhaps the EV space in terms of technology, and so on. So there's a little bit of long-term hope here, but the short term, I don't think there's much to be spoken here. You have to brace for impact. You have to live through the pain that will come here. And while these companies are not very richly valued, there is still scope for, I think, movement on both sides. So I would say, expect that the markets are not going to be kind to the IT industry for the next. Don't hide in the IT industry for sure. It's not going to be very kind to it.
So, brace for impact, Mr. Shenoy, is what you say. And is that something that you would see in the mid-cap IT as well? And just wanted to take a point forward of auto that you mentioned. We have seen stocks such as, Sona, BLW, Samvardhana Motherson, and Tata Motors because of the JLR from exports to UK. These stocks get, corrected sharply. But we've also seen some impact on the domestic focus ancillary companies as well. So, do you see that there is any opportunity in that space? And of course, do you see the mid-cap IT to do slightly better in this particular quarter versus the large cap ones, and anything that that's on your radar as well?
So in general, the ancillaries will do okay if the Indian, auto sector recovers. We haven't recovered for 6 years now. meaningfully. Of course, some companies have done better. The M&M has done better. We own it. Maruti's done okay. Hero MotoCorp has not done so well. So it depends on which companies will kind of be affected if the India does a deal with the US in terms of reducing tariffs on cars. Now, I don't expect Indians to buy American cars. To be honest, even if you saw Tesla say they'll come in at 25 lakhs, after you put GST and this and that and all that, that car will become 45 lakhs. By the At that 45 lakh price point, the competition of the Indian automakers is not so much. It's like no, they're competing with the Germans and perhaps some of the high end automakers like even Mercedes, the ones that import their cars full. I don't think this is meaningfully useful as a as competition if the car price points are at 45 lakhs plus. But if they're lesser, then of course competition does start to set in. So the question is whether we do a deal only with the US, whether the Europe also forces us to do a deal, how this deal structure works. If Europe does not give access to their market but demands concessions from us, obviously we're not going to do anything about it. So a lot of these structures are going to be in play for the next 3 or 4 months. I expect though that domestic manufacturers are very good at two things: at understanding the Indian roads, which needs a slightly different approach from many of the other foreign companies. And they understand the Indian market and mindset for service, which is typically because of their dealer networks, they have a much larger reach. So I think they will survive and they will grow from here. However, we'll have to wait for the contours of this deal to actually say how badly they will be impacted.
Deepak, so therefore, of course, there's no lack of uncertainty at this point, and that's the key problem which is marring investor minds. In your view, what is it that looks good, and how should you play markets at this point? Or should you stay away, move to debt for a bit? How are you playing it?
No, I think markets, these are normal moves in the markets. It's not been massively bad for us. America has seen some 20% here and 10% there and all that. We have seen like maybe 4 or 5% here, 4 or 5% there. If we're down, maybe I think right now also, perhaps we're down about what, 13, 14% from the top in the large caps, and maybe 17, 18% down in the mid and small caps. So it's not like it's a massive downturn meaningfully. I don't feel also that this is a point where you should go out and put yourself money into cash. Probably the wrong time for it. In fact, I would say this is actually a very interesting time to start investing. It has been for the last month and a half or so. And I would say at this point, even though, see, we are up on a month-on-month basis. That means same time in March to same time now, the index and most portfolios are actually a little bit higher than they were. So you can see all this turmoil happening, but the markets are not going down so badly that we are, in doldrums or something like that. So I would say at this point, make your bets. If you have money to invest, this is a great time to start investing. Times of uncertainty in general are times to invest, and let your fund managers, if you're investing in mutual funds, take those decisions on what stocks to buy. But also, if you're buying stocks yourself, I would say focus on sectors that do not have so much trade involved. So anything that is too heavy on exports or imports is going to get more affected than a company that serves the domestic economy. I mean, for instance, we talked about Reliance. Reliance has a section that imports oil and exports petrol and diesel and all that. But they also have Geo, which is primarily about domestic telecom, the cinema, the Hotstar, and the entertainment stuff. There is the retail pieces, which are almost primarily domestic. I would say focus on companies which have that side of things rather than on the export side of things. So, it's just going to be a matter of a time before we get out of this. But you'll have to live with the pain for a year anyway. Might as well start the investing process as well.
Thank you so much, Deepak, for coming in, giving us that perspective. Good having you here.